SVB and Signature Bank failed over the weekend. Let's explain how it affects housing next. Silicon Valley Bank and Signature Bank failed since last Friday. And obviously, when you hear bank failures, there's some fear. There's anxiety of a flashback to 2008 when we saw a lot of financial institutions have major issues. The federal government came out today and said depositors at SVB will be able to access their funds after a run on deposits over the weekend caused Silicon Valley Bank to be over $950 million in the red after $42 billion was withdrawn by a lot of their customers. Signature Bank went through something similar over the weekend, and now we've got all this fallout, and people are worried, what does this mean for the housing market? How will this affect loans? And we've already seen that these failures caused the 30-year fixed rate to come down pretty dramatically into the 6.25% range as of Monday versus north of 7% at the end of the day on Friday. And here's the thing to know about these banks. Silicon Valley Bank invested heavily in crypto, VC and tech startups, and bonds that were very sensitive to interest rate hikes, which we've seen a lot of thanks to the Fed. Signature Bank was also a very heavy crypto banking institution. So you can't just say these banks failed because we're in a financial crisis. They decided to put their portfolio into very risky areas that caused the run on Silicon Valley Bank in the first place. There's been a lot of cash in the system thanks to the government spending that we've seen, COVID bailouts, and all these different things. So VC funding has become a little risky. Crypto, super risky, if you ask me. And obviously, we know what happens with bonds when they're sensitive to interest rate hikes in the current climate. So that's what happened with these two banks. So now, what does this mean for the housing market? This is the biggest question we've been getting over the past 24 and 48 hours. So I want to explain that to you. Real estate, it's a tangible asset. It's something you own. The building is there, and you can collect rent or live in it depending on if it's an investment or your primary residence. So there's some safety automatically with a much more traditional asset as opposed to cryptocurrency or venture capitalist funding in tech startup ideas that have high failure rates. Let's call it what it is. So you're already investing in a safer asset when it comes to real estate. On top of that, lending costs just came down, which is going to benefit a lot of buyers. So what I'm clear on is that these bank failures, from talking to a lot of sources that I have, high up in major banks, high up in different companies, these could be isolated. In fact, I put out a piece on social media on Sunday before the news of Signature Bank broke. And what it said was that you have to be really worried about maybe the commercial real estate sector or regional mid-sized banks, and all of a sudden, Signature Bank checks that box and had the same risky portfolio. So that's the people that need to be nervous here, not the big banks that are lending on single-family residences, because there is so much demand for single-family residences right now, and that's not going away with the millennial population and a really strong job market. So these failures don't concern me. They don't concern a lot of experts, people that are high up in different banks across the country that are more traditional with less risky balance sheets. So on top of all that, we've seen the 30-year fix come down, and now the Fed may stop raising rates. If you look at the CME Group's Market Watch tool about predictions of what happens at the next Fed meeting, just last week, it looked like there was going to be a 50 basis point increase, and that was much more likely than the 25 basis point increase. As of this morning, there is a 37.3% chance we see no change to the federal funds rate, and a 62.7% chance we see a 25 basis point increase, which is far less than what we were talking about even a week ago. And again, with the volatility and the news and all these things that are going to be coming out later this week, like the CPI data, and we already saw what the jobs report did, here's what I know. Real estate is a much safer investment. The demand is there for single-family residences. Those are long-term loans. I don't see these bank failures having any effect on real estate. In fact, it's brought down the cost and it's made homes more affordable than they were just a few days ago. Certainly, you want to keep your eye on things like this when banks start failing. When you're looking at their portfolio and look at how volatile crypto is, how volatile venture capitalist funding are in startup companies, it's conceivable why these banks failed. The housing market, still going strong.